nothing to it but to do it. What the FTX collapse means for your finances. This is why we can't have nice things. Investigators, regulators, internet wannabes are all saying that the collapse of FTX is similar to the collapse of Theranos and Bernie Madoff's Ponzi scheme. While that's well and good, and kind of exciting to hear about and I guess in a way depressing to hear about, but what, if anything, does this mean for your average investor? Well, let's find out. I'm Derek West, this is Finance Squared, and on this channel, we love talking about everything personal finance, whether it's stocks, bonds, cryptocurrencies, credit, debt, anything and everything personal finance. Be sure to like, subscribe, and click the notification bell to get more videos just like this one. Financial turmoil, well, it isn't easy to understand, let alone to predict, as you may know. Like those two sagas I just talked about, Theranos, Bernie Madoff's Ponzi scheme, and a series of other ones that have gone on throughout history, Enron, etc. The collapse of once solid institutions can surprise investors and cause an even larger general panic. This can leave investors, that's you and me. We may have only had a passive or secondary investment in the toxic asset or in the bad position. This general panic can lead to our investments dropping even further. This is why the collapse of FTX in early November has left many investors wondering what this means for their money, and even more carefully ask and Googling, what the heck is all the hubbub? Now, even at this very late moment, it's too early to tell how this will affect specific crypto tokens and stocks surrounding crypto tokens, how it's going to affect them in the long run. Even with that though, there are a few things that can be said about this whole mess and how it will likely impact your finances. And as I'm sure you already know, financial markets are volatile by their very nature. Successful investments one day may drop dramatically the next. That's just how things go sometimes. However, when an entire exchange fails in less than 24 hours for any reason, well, that's not good news for anybody, since that leads to a lack of confidence in the market in general, leading to a general panic, which is generally the most irrational type of panic. Irrational panics can give many rational investors who are paying attention opportunities to grow their wealth while everyone else is running around with their heads cut off. Now that stated, it also means short to near-term pain while the market is sorting itself out. So all this bluster really means if you don't panic and you pay attention to the fundamentals and technical analysis of any crypto stocks, of any crypto tokens that you're holding, stocks around those tokens, or even exchanges, whatever you may be holding, and you act appropriately with that information, rationally, you should be fine. If you behave irrationally, however, you're likely to get a very rational yet unwanted result, which is to lose your investment by buying high and selling low. On November 11th, FTX, a major cryptocurrency exchange, and its American subsidiary, FTX.US, both of those entities, they filed for Chapter 11 bankruptcy. And during that same time frame, in fact, on the same day, there was a major hack into the exchanges where over $600 million in tokens were stolen from their customers' wallet. Advisors of FTX who are managing the bankruptcy process, well, they've had difficulty locating the majority of the assets for the firm. And that's according to Bloomberg. And this implies that there may be limited resources accessible to reimburse the people FTX owes money to. Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information as has occurred here. That's me quoting John J. Ray III, who's known for guiding Enron through its bankruptcy and liquidation process. He also said that FTX had many problems, including compromised system integrity and faulty regulatory oversight. They also had concentration of control in the hands of a very small group of inexperienced, unsophisticated, and potentially compromised individuals. So based on that assessment, it would seem quite a lot of money and power was in the hands of people who had little experience, guidance, and oversight. Honestly speaking, though, that is sort of a common occurrence in enterprises that are based on new technology, which cryptocurrencies are. Nevertheless, FTX was one of several firms looking to bring crypto trading technology to the mainstream of financial trading, and its collapse has had widespread impacts on crypto markets, with various exchanges that had exposure to FTX or one of its subsidiaries facing downward market pressure. The history of the FTX collapse and the history of FTX in general, well, it's a crypto exchange, and it's similar to that of other exchanges in many ways. If you paid attention to several events leading up to the collapse, there were some hints that some mischief was afoot. FTX was founded in May 2019 by the now infamous Sam Bankman-Fried. You know, when I first saw his name, I thought it was Sam Bankman-Fried, here on out known as SBF, as well as the co-founder of this institution, Zhao Gary Wang. Now that's a name that I dare you to say 5 times fast. It started off as a spin-off of Alameda Research. That's a trading firm founded by Bankman-Fried and others in 2017 in Berkeley, California. 6 months after the founding of the firm, Zhangpeng Zhao purchased a 20% stake in FTX for about $100 million. Zhao sold his stake for approximately $2 billion in July 2021, making the Binance Scion one of the few individuals to actually make money with FTX. In August 2020, FTX acquired Blockfolio, a cryptocurrency portfolio tracking app for $150 million. In July 2021, FTX raised $900 million at an $18 billion valuation. In September 2021, FTX moved its headquarters from Hong Kong to the Bahamas. Definitely an interesting corporate journey. On January 14th, 2022, FTX announced a $2 billion venture fund named FTX Ventures. In November 2022, FTX Ventures website went offline. In January 2022, FTX raised $400 million in Series C funding at a $32 billion valuation. These numbers are starting to get a little crazy. I'm sure you agree. Now, FTX US declared on February 11, 2022, that it would soon provide stock trading services to its US customers. They also plan to develop a gaming division that would assist video game developers in adding cryptocurrencies, NFTs, and other blockchain features to their platforms and to their games, to their systems. One of the more famous cryptocurrency entities out there, BlockFi. They were purchased by FTX in July 2022 for up to $240 million. A $400 million credit line was included in the deal. In August of 2022, the FDIC published a cease and desist letter accusing FTX of making false and misleading statements on FDIC insurance as a result of FTX President Brett Harrison's tweet. After deleting the tweet and clarifying that FTX does not have FDIC insurance in a follow-up tweet, Bankman-Fried tweeted that FTX didn't have FDIC insurance. On September 26, 2022, FTX US was awarded the auction for the digital asset of bankrupt cryptocurrency brokerage Voyager Digital's digital assets for $1.42 billion. The deal was contingent on bankruptcy court approval, as well as Voyager Digital's cryptocurrency holdings, which amounted to $1.31 billion and $111 million in additional consideration. Because of this, Voyager's creditors accepted the deal. Brett Harrison, president of the FTX US, announced on September 27, 2022, that he would be stepping down from a busy role at the company to maintain an advisory position. Harrison had been the FTX US president since May 2021. The company did not at first announce success for Harrison, who had been the president since May 2021. As you can see, quite a lot of spending in the years between 2019, FTX's founding, and 2022 when they officially collapsed. As with many financial collapse scenarios, the reason for the collapse is multifold. One thing that many people note as they try and break down the collapse of FTX is that the firm was allegedly funneling money back to its founding company, Alameda Research, to execute what a lot of people are calling risky trades with investors' money. Now, more details will undoubtedly unfold on this relationship as the days and weeks move on and as the court case of this plays out. But just from a 1,000-foot view, if this practice's legality isn't in question, its ethics certainly are not. Moving money from one entity to another to then invest the money from one entity to another gives people the impression that your enterprise is a Ponzi scheme. Definitely not a good look. But most importantly, people had lost faith in the leadership of Bankman-Fried in particular and the direction that FTX was going in. The reasons for that, well, they're unknown. There are many stories about the behavior of FTX senior officials, what they were doing on islands, and in addition to some of the habits that they kept up while being senior officers at the company, while managing a lot of money. What I'm trying to say is they weren't instilling confidence in the people that they were leading. One might say the biggest contributor to the downfall of FTX was the general pullback of cryptocurrency, which kicked off earlier in the year. This pullback most likely caused other dominoes to quickly fall. A similar situation happened to Bernie Madoff when his enterprise collapsed. A lot of people forget that during the 2008 and 2009 timeframe, the stock market and the real estate market crashed a lot of the economy, causing people who had money invested with Bernie Madoff to attempt to call in their bets, as it were. And since Bernie Madoff was using the money that people invested in to give the illusion of profits to other people, when a large number of people began calling for their money, all of a sudden he couldn't pay his bills. People are beginning to speculate that that's exactly what happened with FTX as well. But this, I think, is a key point that a lot of folks are missing. Crypto had been falling for about a year leading up to the collapse of FTX. And that general price drop led to the lack of liquidity that exposed FTX, FTX US, and Alameda Research. If crypto markets had continued on their upward trajectory from 2018 to 2021, confidence in FTX may have been maintained for months or even years more. And that only would have perpetuated FTX's and Alameda Research's interesting relationship for a longer period of time. What does the collapse of FTX mean for investors? The collapse of FTX has been compared to the collapse of Bernie Madoff's Ponzi scheme, since Madoff purposely misled the customers into believing that they were profiting off of his investment prowess, when in fact he was just paying for earnings with new investors that were coming on board. In the case of FTX, there was most certainly a misappropriation of funds from a 1,000-foot view. The legality of this is all going to play out in the months and weeks to come. But we can say at the very least it was an unethical and possibly criminal way to execute their responsibilities as leaders of these organizations. In addition to that, the record keeping and corporate controls / oversight simply weren't there. But that said, FTX did in fact act as a crypto exchange. They were not, based on what I've seen, taking the money of customers who are looking to buy cryptocurrency from their exchange and then using that to funnel money into Alameda Research. They were taking customers' money when those same customers were looking to purchase crypto tokens or trade with crypto tokens and actually give them crypto tokens. The misappropriation of funds, the malinvestment in funds seems to be coming from, again, from my 1,000-foot view, seems to be coming from the investment capital that they were allocated. In many ways, it seems as though they were trying to gamble with the investment money that they were given. Time will tell. With that being said, the actual business of FTX was simply not as valuable as people made it out to be. And the difference between what people thought it was worth and its actual cash flow was eventually brought to light by the falling values of cryptocurrency in general and of FTX native token FTT. Combined with the lack of confidence people had in the firm, the money that was pulled out, and questions surrounding the larger movement of money between the two firms, the collapse was almost inevitable. So despite what many people say, crypto, it's still a niche investing asset class. It has been getting a lot of popularity. Nevertheless, it is still niche. And those folks that kept their money in the cryptocurrency sidelines, those retail and institutional investors, well, they will have little to no direct exposure to the collapse of FTX. Crypto trading in general has grown exponentially in popularity, and a large portion of investors have crypto exposure. Most investors have not purchased their tokens through FTX, and thus are largely shielded from this misadventure. Largely, but not entirely. A lot of people have begun to associate the large drop-off in the value of crypto with this scandal, much like they associated the stock sell-off in 2008, 2009, 2010 timeframes with Bernie Madoff. But the correlation is that the loss of confidence in stocks caused the pressure on Bernie Madoff that eventually led to the collapse of his scheme. It's very much the same with FTX. The larger crypto meltdown led to Bankman-Fried's firm being eventually exposed, and eventually not being able to cover its substantial bets through its relationship with its trading arm, Alameda Research. I no doubt expect more drops in crypto, particularly now that FTX has begun their bankruptcy proceeding. More shoes are most certainly going to drop. As it were, the fate of Binance, for example. They're a prime example, as the Singapore Financial Regulatory Agency will be investigating Binance for violating payment rules. That action could be signaling that regulators will be looking more closely at crypto firms and exchanges in the coming months and years to come. I'm not even going to mention that this saga in general is going to cause already anxious regulators to take a closer look at the state of other exchanges if they discover similar problems with other systems, and there's sort of a larger contagion and a culture of risk-taking with investors' money. Well, there may be larger actions against crypto in general. Was this simply Sam Bankman-Fried's and FTX's and Alameda Research's problem, or are there other firms out there doing much of the same thing? With the growing number of scams and fraudulent crypto schemes, the SEC is under increasing pressure to find ways to protect investors. And that could mean taking a very hard stance on crypto, similar to what happened in China in the year 2021. And that can only mean more stringent regulations and more strict enforcement, heaven forbid, possibly an outright ban of cryptocurrency, which has been called for by some US politicians. At the very least, there could be exchange consolidation in the near future as other exchanges collapse from the fallout. Theoretically, this could have a significant effect on your investment strategy. What should you do now that FTX has collapsed? Well, first things first. Remember, this is a fluid situation, and things change day by day. Stay current with news regarding your favorite crypto exchanges to see if any of the crypto contagion has been passed along to them, and to make sure that those exchanges have liquidity so you can pull your investment out if warranted. Now, if you're a crypto trader, then this is probably something you're already likely doing. But it becomes doubly important if you just own a couple of tokens and are in the crypto periphery. Something you want to keep in mind is that you shouldn't overreact. When things get rocky, it's tempting to just sell everything and head for the hills. While this oftentimes seems like a good idea, it could cost you dearly in the long run. As I'm sure you know, and as I'm sure you've heard if you're a follower of this channel, you oftentimes find the best bargains when the prices are lowest. Dollar cost average your losses, and if you are in a position, maybe consider picking up more cryptocurrency with an eye on staying diversified in your entire portfolio and not just being in one asset class. I'm a big believer in crypto, particularly if it can find a way to maintain a lower value profile. In all honesty, crypto is already way too expensive and could probably stand to lose a little bit more. That being said, I'm not betting that will happen, as I'm sure plenty of people have a lot invested in crypto, particularly Bitcoin, Ethereum, etc. And I'm not one to short crypto either. To a large extent, I'm saying that being invested in other asset classes is a smart idea in general. Whether that's stocks, bonds, art, you're better off having your investments spread around instead of just being in one place. So the collapse of FTX is a major black eye in the cryptoverse. It's probably just the first in a series of crypto calamities that may follow. But this wouldn't be the first time that a major correction has occurred in an asset class. Think about real estate in 2008 or stocks in 2000, 1987, 1929, etc. One might think of this as just part of crypto's growing pains. And the future of cryptocurrency as a currency with minimal middlemen is almost limitless. Now it's over to you. What do you think? Be sure to let us know in the comments down below. Don't forget to like and subscribe and click the notification bell for more great videos just like this one. I'm gonna get out of here, guys. Take it easy. Peace.